everyone, and let's start this keynote session. And it's a great pleasure for us to receive Professor Bernard Black from Northwestern University. And Professor Bernard Black has, as you know, an outstanding curriculum and a lot of main contributions to the field. And it is obviously any one of us can go to the internet and Google and look for his CV on the Western page, and 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 someone very known in the field. I would like to mention his positions in the Northwestern University. He's Nicholas Chabraja, is that the way we say it? Professor in Northwestern University, as professor in the Pritzker School of Law and the Kellogg's School of Management, Finance Department, and is faculty associate in the Institute for Policy Research. And so it would be very long to read all his curriculum, but I think very interesting that in the page it is noted these principal activities: corporation, corporate finance, corporate acquisitions, health law, law and economics, research design for causal inference. And in my case, I'm glad to see that we have access to the last NIH or applications and fundings he got. They are all related to health sciences and politics in health sciences, and he has been very interested in this field lately. I say I'm glad because I'm a pharmacist in my undergraduation school and molecular biologist. So, Professor, it's a great pleasure to have you, and please.
All right, thank you. So thank you for the opportunity to be here. I think like Michael yesterday, I'm delighted to see something of the international spread of empirical legal scholarship. Hopefully I've contributed to that. You know, two former students of David's and mine, Mohammed Rahmati and Kozer Yousefi, are in the back room. Back row, I run this annual workshop at Northwestern on research design for causal inference that hopefully also tends to spread knowledge about how to do causal inference right, not only in the U.S. but more globally. I think the Conference on Empirical Legal Studies, both in the U.S. and elsewhere, has been has been a part of that. So this is going to be a project on, let me call it, what can go wrong. Okay, with research that claims to find causal effects, but I will argue to you often doesn't. So this is joint work with Himang Desai at Southern Methodist, with Kate Ledvak at Northwestern, Wong Sun Yu, a former student who's now at Central Michigan, and Jeff Yu. And we're going to look at the first SEC genuine randomized experiment on the effect of short sale restrictions on outcomes in financial markets. And the subtitle here is going to be The Road to False Positives and the Evidence of Specification Choice. Maybe as background, so let me start with this. I want to start with a picture of my son Danya, who died a couple of years ago. This is a picture from the Golan in Israel. And I didn't want to show up today and pretend that everything was good in the world, either for me or for Israel, where I just came from. And I'll say a little bit more about that at the end. I will say that it is tempting for researchers to torture their data until it confesses a significant result, hopefully with a preferred sign. And I don't know, I find that I get more than my share of null results, and I attribute that to not torturing the data quite as often or quite as hard. But there are lots of results out there that I don't believe in. I'm going to show you some of them. So in corporate finance and accounting, and so this is going to be field specific, but I think the message is more general. Causal inference, which we sometimes call identification, is hard. Everything is endogenous to everything. And so you look for potential responses, you look for natural experiments, you look for regression discontinuity, you look for differences in differences. Sometimes you can find an instrumental variable. The best standard, which you rarely achieve, is a randomized controlled trial. And so we're actually study one of them. And the message is going to be, if researchers can screw this one up that badly, how much more can they screw up when they only have a natural experiment, not a true experiment? So this project is going to be about tarnishing the gold standard. There are now an assembly of 70-plus papers finding all sorts of indirect effects from the SEC short sale experiment. And maybe some of them are true, but I haven't found one yet, and I'll show you that the 10 that we looked at aren't close to being true. One concern with using the same experiment over and over is multiple hypothesis testing. That was explored in a paper in Journal of Financial Economics last year, where they recommend that just to compensate for multiple hypothesis testing, you should require a t-statistic of greater than 2.8 or so. There are other people who have called for a t-statistic of around 3 as a minimum standard rather than the 2 that we now use. Our concern is going to be different. Is there a credible channel, causal channel, for the indirect effects? Let's start with a question of, is there a causal channel? Difference in differences technology allows you to skip that question and just see, is there an outcome? But I think you shouldn't skip it, because if you don't find a credible causal channel, then you should start with, let's call it a Bayesian thumb against believing your results, should be more careful, should require higher t-statistics, more placebo checks, stuff like that, even before you get to multiple hypothesis testing problems. So my first goal today, and please interrupt with questions as you will, let's treat this more as a seminar. I'm going to try to persuade you that most or all of the results from this array of papers are false positives. I can't go through 70, but I will go through 10. I will try to persuade you from a prior paper that there's no evidence of a causal channel, and that's from a paper that's now published earlier this year in Management Science. And then we'll go through a set of 10 papers published in good to excellent journals, and we'll first apply a pre-specified research design, where we're going to take the same design across all papers to the extent we can. We're going to write it down in advance. So we made lots and lots of specification choices. We couldn't avoid that, but at least we didn't make them with any conscious bias. And at least we used the same choices, like what's the sample, what are the time periods, consistently across all papers. So we're going to look at these 10 papers and a bunch of outcomes with our pre-specified design. Then we're going to say, okay, let's read the papers and figure out what we think they did. Sometimes that turns out to be surprisingly hard. Sometimes we had to guess. Sometimes we've surely guessed wrong. Sometimes we know we're not close to what they did, but we don't know why. We're going to find that even with their best match specifications, more often the results are closer to the reported, but they're often not very close. So there's a big gap between the best match, which isn't truth, but is the best we can come based on what they said, and what they report, that there's a bunch of play in the joints that isn't even being discussed. Maybe the researchers didn't think it was important enough to be worth discussing. That has got to get you from best match to reported. And then for 2 of the papers, we do have their exact data set. We can assess both technical replication and then see whether the results are at all robust, and we'll conclude that they're not. Okay, so background on the short sale experiment. The SEC started with the Russell 3000 firms. These are the largest 3,000 firms traded in the US by market capitalization. It ranked them by trading volume over the year before they announced the experiment, and they picked every third, 1 out of 3, to be a pilot firm from whom they were going to remove short sale restrictions. They did so separately within the New York Stock Exchange, the American Stock Exchange, and the NASDAQ national market, and then they're going to suspend the New York Stock Exchange uptick rule and the NASDAQ bid test for pilot firms. The uptick rule is basically you can sell short only on an uptick or a 0+ tick. So a few of the people in the audience will know what that is. It doesn't matter. Okay. Point is, there were some short sale restrictions in the markets prior to the SEC experiment, and the SEC was going to say, we're not sure these really matter anymore. let's flatten them for 1/3 of the firms and see what happens and see if they really matter, okay? The other 2/3 of the firms were going to be the control group. For the controls, they suspended the uptick rule after trading hours. And you might think, well, gee, does that really matter? If you can trade after hours, we're going to have that question too. And the NASDAQ rule never applied after hours. Okay, experiment announced in July 2004. There's a 2-year experiment period. Started out being 1 year, but then the SEC developed enough evidence and researchers developed evidence that there wasn't much effect of the rule, so they were planning to get rid of it. So they decided not to put it back in place when they were planning to get rid of it. So 2-year experiment. First thing I'm going to show you is there's no evidence for the principal causal channels. Then we're going to show you some evidence for the set of papers that we looked at, that the results are not robust. They don't survive with our design. They don't survive with the best match specification. And the technical replication that we can achieve is really fragile. Why did we choose these 10 papers? Well, we chose the first 4 because they were published in top journals, and because, hang on, I'm going the wrong way, in Journal of Finance, in Review of Financial Studies, in Journal of Accounting and Economics, and in the American Economic Review. And they had data that was simple enough that we could reproduce it using standard data sources. So those were our criteria. We could good placement, data we thought we could reproduce. We then expanded to go to 10 papers instead of 6. The next 6 are good placements. One is a working paper with a top finance author. And our goal across these is going to be to now look at, we know that there are a bunch of false positives. How did the authors get there? What are the lessons we can draw about what to do if you want to get to false positives? Or maybe what to worry about if you don't, right? We could have written this as a guide to finding false positives by really trying when no true result exists. So back to the SEC experiment. There are several kinds of short selling. 2 of them are mostly or fully hedged. One is index arbitrage. The second is dealer market making. We're interested in substantive short selling. Short sellers look at firm-specific information, say, I think this firm's shares are overpriced, absolute or relevant terms, based on firm-specific information. They're going to build short positions gradually. They're going to hold them for a long time, gradually so they don't tip off the market, and because a long time because it's going to take a while for the bad news to come out that they expect to come out. Only the third type is relevant for indirect effects. Managers don't care about index arbitrage. It doesn't affect their shares at all. They don't care about dealer market making. That's not affecting their share price at all. If they're going to care, it's going to be about the substantive short selling. All right, so our prior was that by 2004, short sale restrictions were nearly irrelevant. That was the SEC's prior too. That's why they ran the experiment. Why? Well, the tick size, the minimum increment between pricing, had dropped from $0.125 to $0.116 to $0.05 to $0.01, and there was inflation, and $0.01 wasn't what it used to be. So the minimum trading increment was way, way smaller than it used to be, and the short sale restrictions were based on upticks. Well, the upticks were way, way smaller than they used to be, and arbitrage was generating tons of upticks unrelated to fundamentals. So you didn't have to wait very long for an uptick. You could just wait for index arbitrage to give you one. Furthermore, the secondary exchanges, so the New York Stock Exchange has secondary exchanges, NASDAQ has secondary electronic exchanges. They had a meaningful share of volume, and they didn't enforce these rules. So if you wanted to get around them, you could go to a secondary exchange. Third of all, 2/3 of the Russell 3000 by this time had publicly traded options, and you could simply rely on put-call parity and engage in an options trade that's equivalent to buying shares, and you didn't have to worry about the short sales restrictions. Then finally, off hours, there were no restrictions. NASDAQ, there never were, so the restrictions were only during the trading day, and the New York Stock Exchange, under the experiment as run, the SEC relaxed the restrictions after 4:15 for the R1000 and after 8 o'clock for the R2000. So if you're not in a hurry, and short sellers aren't in a hurry, remember they're building their positions over months, you can wait and trade after hours. You can agree during the trading day to complete a trade after hours. You're not in a hurry. The short sale rules were especially relevant for NASDAQ firms. I can explain why, but it'll make me dive deeper into the technicalities of market trading, and so I won't do that here. But believe me, the NASDAQ was less likely to have any effect. And so the word on the street, the Wall Street, from practitioners was the uptick rule just didn't really matter anymore. It didn't meaningfully restrict short selling. It did limit index arbitrage. Because if you wanted to trade 500 companies at once in the S&P 500, only some of them will have an uptick. So you needed a fancy computer program to trade what you could and then wait 27 seconds for this company and 34 seconds for that company to be able to trade. And that was annoying and increased transaction costs and made arbitrage a little bit slower and less efficient. The political economy for us is this is why the SEC could run the experiment. The rule wasn't important, so firm managers didn't object. If it had been really important, it never would have been run. All right, direct effect of the SEC experiment. The early studies find small effects. More short sale volume, that's consistent with more index arbitrage. That's an expected result. Better liquidity, lower bid-ask spreads, again, an expected result of reducing frictions in markets. But for substantive short selling, there was no effect on open short interest. What's open short interest? That's the fraction of number of shares, fraction of total publicly traded shares that are sold short at any given time. This is a metric that the stock exchanges keep track of and report publicly. That's our best available proxy for how much short selling actually exists. Not a perfect one, but the best we've got. No effect on open short interest, no effect on share prices, no effect on a bunch of other things that I've got listed on the slide, no effect on price efficiency, no effect on options trading. So where do we get these 70 papers finding all these indirect effects when the direct effects were really small and shouldn't have had any meaningful impact on substantive short selling? That's going to be our question. Principal posited short channels. Well, some of the indirect effects papers think about causal channels, not all. But here are the main ones that are cited. One is open short interest. Again, it's the best available proxy. Another is share returns. Well, if the experiment doesn't affect short interest, I wouldn't expect it to affect share returns either, but we can look directly. We can look at share returns. If you don't affect short interest and you don't affect share returns, why would managers care? I don't know. The third purported channel is manager fear. The managers were worried about short seller attacks, bear raids as they're called, even if the raids never came. They were scared, they reacted, so there's no evidence that the raids ever came, okay. But they reacted anyway. Note, however, that the manager fear channel, we're going to find no good evidence that it existed. By some time, the managers should have figured out that the bears weren't charging and gotten less scared. So this would predict an effect that's stronger right at the beginning and then trails off over the course of the experiment. And then price efficiency, we didn't study that directly, but other papers have. No evidence of any effect on the efficiency of market prices. All right, so causal channels. Here's open short interest. And the red line is the control firms. The blue line is the treated, the pilot firms. Do you see any difference? The first line is experiment announced. The next line is experiment starts. The third line is experiment ends. I don't see anything. But one of the papers we respond to, Gruel on Mission Northwestern, says everybody else had looked here and found nothing. They said, we're going to look here after announcement and before adoption. Now, who knows why you would expect anything there, but they're going to say they found something. Oh, I'm sorry, we don't, right? There is no effect. We don't know why they thought that. We do know why they thought there was an effect. They screwed up their analysis, but that'll be a side point for this talk. How about share price? So here are biweekly share prices over a long period of time, right? And it kind of looks like noise, and the red lines are the 95% confidence intervals. Do you see an effect of the experiment on share price, share returns? If you don't, you're not looking hard enough. Here's the effect that Grulon, Michenon, and Weston report on. Right here, just before announcement, there is a statistically significant decline in the price of pilot firms. You know, T-stat of 2.2 or whatever it is, right? And they say, aha, if people anticipated the experiment and they traded before the study was even announced. Well, I look at this and say, I see a whole bunch of noise. But there are more problems with this story. One is, depending on how you, they say they find an effect for small firms and not big firms. They define small firms based on assets. If you look at small firms based on market cap, you see nothing. If you look at New York Stock Exchange versus NASDAQ, you're going to see an effect only for NASDAQ. It ought to be the other way around. But beyond that, right, the SEC, the Securities and Exchange Commission, has market-sensitive information all the time. They're thinking about investigating or suing this or that firm or something else. I have never heard of a leak. To trade before the announcement, you had to have the list of 3,000 firms, because otherwise you couldn't tell from what the SEC said who was pilot and who was not. There were details. We exclude this firm and this class of firms and that class of firms. It wasn't specified that we're going to trade we're going to rank separately within each market. They just never said that. And if you get it wrong by one firm, you've screwed up the whole thing. You had to have the list. You had to have stolen the list. So somebody had to steal the list, trade on it, and then other people had to know that they stole the list. Otherwise, they would have traded after the announcement. That's kind of weird. We don't think it happened. Is there a manager fear channel? We can't test that quantitatively. What we can do is look for evidence in news stories, in manager comment letters on the SEC rule, where the SEC goes through this notice and comment procedure in the US. They announce a proposed rule, they get comments, they do a revised rule. We find nothing, no evidence that managers were against the rules. And, okay, managers weren't apparently scared, and CEOs of big firms are not these sort of timid people generally. They're not going to be scared so easily. All right, so no causal channel. That's going to lead us to propose a Bayesian thumb on against finding end results. We would feel the same way if the causal channel, well, maybe it exists, but it's not so strong. Okay, so now we're going to take this, take it to the data. We're going to skip over the problem with causal channels. We're going to look at 10 papers. Again, I think we're picking better papers. It's easy enough to knock down bad papers. We picked papers that first had data we could reproduce and were published in good to excellent journals. We're going to look at the outcomes they studied. Many of them studied multiple outcomes. In some cases, we're going to say, you studied outcome X, but we think if X is true, then you should see a similar result for outcome Y or outcome Z or outcome W. We're going to look at a set of related outcomes and see if we see a consistent result across outcomes. So we've got 10 papers. We're going to look at 69 outcomes, and we're going to find that 3 of them are statistically significant at the 5% level. 2 with a predicted sign, 1 with the opposite sign. That is entirely consistent with noise. There's no evidence that there's anything else. And I'll leave aside the list of, you know, all the different measures because we'll come back to the individual papers. Okay, now that doesn't mean there's no true effect. Specification choice is unavoidable. Question we want to ask is, were researchers doing more than that? Were they searching for a specification that would give them results that they could report? Were they p-hacking, as it's sometimes called? I don't claim our results are truth. I only claim that we did our pre-analysis plan. We made many design choices. We're not aware of any particular bias. We think we engaged in choice and not search. Okay, we're going to turn to the best match specifications. We're going to read each paper, do our best to figure out what they did. Sometimes they're going to guess. Sometimes when we can't guess very well, we're going to ask the authors. Sometimes they're going to respond. Sometimes they don't. We'll do the best we can. Almost all results still can't be reproduced. We still get 3 out of 69, but at least the one that went the wrong way has disappeared. 2 of those 3 are weak, and I'll show you why. Basically, if you do graphical analysis, the results aren't really there. And one of them, our t-statistic is 2.1. right? Again, no evidence of anything there. Different papers made many different specification choices. For many of them, as we move from our specification to theirs, the coefficients get stronger, but not always. Most of them still say well short of those reported. And the question I will leave you is, to what extent is the fact that they reported significant results for most of their outcomes, is this evidence of luck or evidence of specification search? For some of them, as we move closer to their move to best match, we get closer. For some of them, we don't. We just, hey, our best match is here and their result is here, and we don't know why, right? Our sample is substantially different. We don't know why. We can't figure out. So let's take a close look at a few of the papers, then I'll take a quicker look at some others, and then I'll try to wrap up. And again, feel free to ask questions, because this will get to be the more technical part, and this isn't the finance accounting audience, so these are terms that you may not necessarily be familiar with. So Fangwan-Karpoff study accruals. Management decisions to report income in a way that differs from cash. Standard public accounting, you use accrual accounting, you try to match your actual income with the time period, even if the cash comes in earlier or later. They study a measure that's called performance match discretionary accruals. I'll explain what that means in a minute. We think it's an odd choice. We're going to use 4 measures. Again, boom, 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 boom. Let's see if we get consistency. We're going to use operating accruals. We're going to use a broader measure of total accruals. We're going to use a measure of abnormal accruals. Abnormal accruals are your accruals relative to what we predict from other firms in the same industry. So it's a standard accounting concept of some accruals are normal and expected and proper, and we're trying to figure out whether you're goosing your results by doing more accruals than your competitors. That's the idea of abnormal accruals. Some people call them discretionary accruals, but they aren't always discretionary. I'll call them abnormal. And then PMDA is take your abnormal accruals, match them to the abnormal accruals of a matching firm on ROA. We're going to call that performance match discretionary accruals, PMDA. And that's going to be yet another measure of accruals. FHK are going to claim results. They show results only with a balanced panel. They claim in a footnote that unbalanced panel results are similar. I'm going to show you that they're not. We prefer unbalanced panel. Why? It's a randomized experiment. There's no reason why you should need a balanced panel. I'm worried about a balanced panel because it creates survivorship bias. I don't have any reason to think survivorship bias would matter, but why create it? And I like bigger sample. Unbalanced sample is a bigger sample. And then eventually we'll show you that technical replication succeeds, but it's fragile. So why do they study accruals? Their conjecture is firms reduce discretionary accruals to avoid attracting short sellers. Okay, maybe. Their causal channel is managerial fear. Why, if you're worried about bear raids, would you report lower earnings? Because that's what reporting lower accruals does. Maybe you'd go the other way. I don't even start out having a hypothesis that the sign of the effect should be lower accruals rather than higher accruals, right? And certainly I wouldn't expect it to be very big because you're hurting your earnings. If you hurt your earnings, you're going to hurt your share price in order to stop people from selling your shares. Okay, I'm not sure. All right, so I explained what abnormal accruals and PMDA are. I don't know why they would have used PMDA. This is a randomized trial. Operating accrual should be unbiased without having to adjust for anything, without having to do abnormal accruals, without having to do performance match discretionary accruals. Operating accruals are a perfectly good unbiased measure. Total accruals are a broader measure that may have more to do with how investors respond. PMDA is noisier. It was invented in the accounting literature, but really only to deal with cases where you expect bias from simpler measures. We like the simpler measures. Okay, so we wrote an early draft. This is now getting to be a bunch of years ago. It tells you how long the project is going on. And FHK responded by publicly posting not just one set of code, but 3, not just one data set, but 3. Their original specification, an updated 2019 specification, as we call it, and a separate operating accrual specification. And they published a response on SSRN, and they applied all these different specifications to different data sets. And then said, no, they said, Black and co-authors say our results aren't robust. They are. We'll show you. We'll go from here, and we'll change our data set, and we'll change our specification and find a result. And to me, this is like admitting that your results weren't robust. Because if they weren't robust with the original data set, changing the data set and changing the specification doesn't make them robust. Just means there's another specification that lets you find them. Okay, they posted their accruals code, and we will technically replicate that. We also looked at a second measure in their paper. I'll show you that, for what's called F-score, which is a measure of the likelihood of a future financial restatement. They didn't post their sampler code for F-score, or their variant, which they call HF for high F. But we can conduct a near exact replication of that because we have their sample and we know how to measure F-score. And it doesn't replicate. I'll show you that as well. All right, so what am I doing here? I'm doing something that none of the papers does, which is go year by year and look to see, this is red is control, blue is treated. Are we seeing what looks like a treatment effect during the sample period? And then, and this at least I think FHK got right, do you see the result reverse afterwards when all firms are the same? They're all treated. If there is a result, it should go away. So we're going to look for both of those. So we don't really see anything. We see a bunch of noise. Nothing for operating accruals, nothing for total accruals, nothing for abnormal accruals, just a bunch of noise. PMDA is noisier. That's why we don't like it. But again, not much of an effect, evidence of an effect. This is with our specification, okay? PMDA with our specification doesn't even have the right sign. It's positive where they predicted negative. So now let me go to the best match sample and talk through what they did and why we have some concerns with it. Okay, so why is there so much stuff on this slide? Because we clustered standard errors on firm. That's what we think makes sense in this context. It's a short panel. You've got 9 or 10 years. There are people in literature who like to do two-way clustering on both time and unit, right? But it's a known problem with clustering, which is the clustered standard errors are downward biased with a small number of clusters. And if you only have 9 years, you have a small number of clusters, so you have the risk of downward bias if you use two-way clustering. We don't have any particular problem with one-way clustering. So we did one-way clustering. That's what we thought was a sensible specification. We can confirm that one-way clustering does the job it needs to do by going back and conducting randomization inference. Pull firms, the whole firm, the whole time series, at random, assign some of them to be treated, some of them to be control, develop a distribution, do it 1,000 times. That's the randomization inference procedure. That should produce something as close to truth in terms of standard error, standard deviation as you can get. And that's spot on with firm clusters. These two series are not meaningfully different, okay? So firm clusters work. What about clustering two-way? So what do? We cluster it on firm and calendar year. Why calendar year? Because they organize their sample by calendar year. Some of the other papers organize their sample by fiscal year. So that if you were going to two-way cluster, you cluster on fiscal year. So we cluster on calendar year. What do you see? It turns out that sometimes it makes almost no difference. And sometimes it makes a huge difference. We don't know why. This is going to be a future project that two-way clustering can produce severe downward bias. Rarely does it go the other way, but it's entirely unpredictable when. We don't have any good clue, right? These are very similar measures. Abnormal accruals, no difference. PMDA, standard errors drop by a factor of 3, and we think the lower standard errors are wrong, okay? But again, best match, we're not close to significance, even no matter how we do standard errors. We also don't get any reversal, right? This is not negative positive, it's negative and then even more negative. So we're not seeing anything with the best match specification either, and with the other three, it's just a C of nothing significant. Okay, if it was significant, I would have put stars on it. So now let's look at their exact posted sample and code. Okay, and we've got their data. So we can again run the other three measures on both an unbalanced and a balanced panel, and we'll get a whole lot of nothing. With PMDA, with an unbalanced sample, we'll still get a whole lot of nothing. We can barely get marginal significance if we cluster on firm and calendar year. And they got significance by having their data set organized by calendar year and clustering on firm and fiscal year. Why did they do that? I have no idea other than it got them the result that they like. I can't come up with another explanation. It was clearly a choice, right? They had to choose how to cluster. We have their code. The code clearly says cluster on fiscal year, even though the data set is using a different variable that they just call year, right? This is weird. But if they cluster on firm and fiscal year, they can get a smaller standard error and they can get statistical significance. That's their result. And so this last column is the only one they report. The unbalanced results, these are the ones that they say in the text are similar, but they don't look similar to me. They're not significant anyway. The coefficients are similar, I guess. With their exact sample, here's what this looks like. Operating accruals, nothing. Total accruals, nothing. Abnormal accruals, not much. Little bit potentially in the second and third years. And then here's the result for PMDA. Okay? Drops and then reverses. But if I look at the magnitude, there was just as big a difference here as there was there. Right? This is looking like noise to me, not like signal. And there's enough noise so that if you have one-way clustering, you don't get significance. All right. Next FHK measure, the F-score. It's a measure of likelihood of restatement. They decide to measure HF score, high F, which is the highest 1% of F scores across all sample years. And the theory is firms who are pilot are subject to short seller raids, so they're going to be more careful and try harder to avoid restatements. We don't have their data in code, but we do have their exact sample from their accruals data set. We don't know how they computed F-score, but we know how you're supposed to compute it. And if they got that wrong, then their old results aren't worth anything. All right? So here's what we get. For F-score, and this is throughout with any specification, there are 3 different measures of F-score with increasingly complicated covariates in the developers of F-score. We get nothing whatsoever. Not balanced panel, nothing with F-score. With HF score, this is our specification. We don't really see much of anything, right? Other than there's a lot of noise. There's going to be a lot of noise. You're only measuring the top 1%. Of course there's going to be a lot of noise. We don't otherwise see anything meaningful going on. This is switching to a different presentation. So what I've done here is to show you T-statistics with firm clusters in red boxes, with firm and calendar year clusters in green triangles, diamonds, and firm and fiscal year clusters, which is what they did, with red circles. Okay? So different specifications going from R's gradually moving toward best match and then near exact. Okay? And this is negative and significant, positive and significant. We get things that bounce around, but they never get close to significance. Best match isn't close. Near exact, pretty close to 0. This is HF3. There are 2 other HF measures, but I'll show you just this one. This is their reported result. I don't know. I can be suspicious. So here are regressions, and what do we got here? So let's look at unbalanced, balanced, unbalanced, balanced. Once again, we like unbalanced. They report balanced. So we're only going to see their balanced results, right? With our specification, we don't find anything, not even close. Coefficients are close to 0. Some of them are positive. If we switch to their best match, we're going to get coefficients close to theirs for HF1 and HF2, actually. Not close for HF3. We don't know why. Our standard errors with firm clusters are a lot bigger. But if I cluster on firm and calendar year, then they drop dramatically, so then I can get significance. So in best match, we would say we found significance with a balanced panel for H1 and H2, not H3, and not unbalanced, right? Their standard errors are actually a lot bigger than ours now, which is telling you something about the erratic nature of firm clustering, right? Okay, now let's go to the near exact replication. And these results just go away. We now have their exact sample. It's not as big as our best match sample. The numbers are a little different, but not that much. The results totally went away when we dropped 10% of the sample for some reasons that not clear why you should drop those firms. I don't know. I don't replicate. I don't know why they chose not to post their replication code, but I can be suspicious. Let me do one more thing. HF score is really weird. The highest 1% of F scores. Now, I know how to run quantile regressions. I can look for a difference at the median, at the 75th percentile, at the 95th percentile, and whatever. What they've done is say, we're going to run a quantile regression and show you only the result for the 99th percent quantile. Like, why would you do that? So we look at this and say, well, what if we picked a different threshold? Instead of 99, we'll pick 97.5, we'll pick 95, we'll pick 90, we'll pick 80. Results are not significant, but what you see is the sign flips for every specification other than 99%. If they had picked 97.5 or 95 or 90 or 80, they would have gotten the opposite sign. Again, I don't know why they picked 99. They don't tell you. They just say, this is our measure. But to me, a natural robustness check is, why did you pick 99? What would you have gotten if you picked another threshold? And the answer is they would have gotten the opposite sign. Okay, back to FHK and accruals. How did they get to their negative coefficient, which is significant if you cluster two-way in the right way? Remember, there was no effect for abnormal accruals. So how do they get an effect for performance-matched discretionary accruals? It must have to do with the behavior of the matching firms. There's nothing else it could be. So they match based on ROA, but when? That turns out to be an important question. The inventors of PMDA looked at matching on current year versus past year ROA and said, we think you get better performance, better specification if you match on current year ROA. In our best match, we assumed that's what FHK had done because they said they followed Qatari. It turns out that what they actually did, which you learned from their code, not from their paper, is match on lagged ROA. Now, it's not a crazy thing to do. You wouldn't even think it would make a big difference. It turns out to drive their results entirely. So what have I got here? This is pre, during, post, the 3 periods before the experiment, during, and after. This is their graph that they present in the paper. They don't go year by year. They do have a pre, during, post graph, okay? So we're going to do it their way, just 3 time periods, pre, during, post. AA, control versus pilot, nothing going on. Now we're going to look just at the matching firms, nothing going on. And PMDA, nothing going on, right? From pre to during, nothing going on. Now let's look at what they did. AA is the same. What happens to their matching firms? The pilot firm matches go up relative to the controls and then drop. This is lagged ROA, this is current ROA. I don't know why it makes any difference. That entirely drives their result. So they had to match on lagged ROA to get their result. They had to cluster on firm and fiscal year to get their result. Enough of FHK. Let me go on to Hopu Zhao. I should say that, how did we get started on this project? Partly we got started because Himang Desai commented on FHK at a conference and explained why he didn't believe the results, and they went ahead and published anyway. And Kate Litvak commented on Hopu Zhao at a conference and explained why she didn't believe their results, and they went ahead and published anyway. So we got annoyed and started a project. So HHZ predicted that auditors were worried about bear raids. Therefore, bear raids will lead to share price drops. Share price drops will lead to shareholder litigation. And some of the litigation will be against auditors, and auditors are worried, so they raise their audit fees so that they can cover their prospective litigation expenses. That's a pretty long causal chain, gives me some reason for skepticism. One might think that one way to test the causal chain was to see whether there was actually more litigation against pilot firms. They didn't do that, but there wasn't. Well, of course there wasn't, because the experiment didn't have any real effects. We also know that the audit market is highly competitive, and I don't even know that this is something that auditors would have paid any attention to. The auditing co-authors, the accounting co-authors don't think so. But okay, they have a theory. It's a long causal chain. We start with our sample, and I don't see anything, right? Control firms have, if anything, a little bit higher audit fees, but not significantly. And nothing closes after the experiment ends. With the best match, the audit fees, again, the treated have a little bit lower audit fees, and nothing really closes over the next couple of years anyway. Okay, so no evidence for a real effect, and to the extent there is an effect, it's got the wrong sign. So how did they get a result? We have their data. We have their code. They were nice enough to give it to us. So we're going to start with their result. And so they give you 3 results: no covariates, a limited set, and a full set. We want to add an intermediate of you only control for log assets, which we know are an important predictor of audit fees. All right? What do we get? Well, first notice that their results are like 5% significance is a T of 1.96. They barely crawled above the threshold. They weren't above the threshold when Kate commented on their paper, but then they tweaked their specification and got a little bit higher T-stat in some bizarre way that I won't go into. But now let's look closely at their data. First, they make a couple errors. They just make data errors. It happens, right? They get fiscal years wrong. They make some data errors. We control for those. We're down to marginal significance. The coefficient drops by a little bit. We then add fiscal year fixed effects, which you should have in any DID design to begin with. We don't know why they don't, right? They're organizing by fiscal year, so fiscal year is appropriate. Now we're down a little bit lower and no longer marginally significant. Then we say, we don't understand why their sample is so small. We have their sample. We know which firms in which years. They're missing a bunch of firm year observations. We're going to go back to CompuStat and collect them and add them in. Now we're down to 0.02 and T-statistic around 1. Then we're going to use, so they match to audit analytics to get audit fees using a matching indicator called CIK. I don't remember what it stands for exactly, but it's developed by the SEC, and it has the annoying feature that it's not time consistent. So in order to make it time consistent, you have to go back in history and figure out what the CIK was then as opposed to what it is now, and for some firms it's changed, okay? They didn't know that. We hadn't done the work ourselves until we got their exact data and couldn't figure out why we were getting different matches. So we decided to go back to this one is indeed subtle. And we're going to get a coefficient, and it drops a little bit more to 0.0171. Then we're going to use all of their firms before they match to audit analytics, and they miss some matches. We don't know why. That turns out not to make any difference, still at about 0.01. And then finally, they impose survivorship bias. The SEC started with Russell 3000 in 2004. They say our sample is Russell 3000 in 2004 and 2005. How does that matter? Who's going to drop out of the Russell 3000? Firms that did badly, because this is a market cap measure. So you're imposing survivorship bias. Why that should matter as to treated versus control, I don't know. But there's no good reason to do it, so we take it away. We've got a coefficient of 0.01, a T-statistic of well less than 1. There's no result there to be found End of story. Let me skip over this because I think I've beat on HHC enough. This is just a whole bunch of different specifications, and can you get above 2? These are the specifications I showed you and many more, and the answer is barely, right, with their specification, but not once you start tweaking it. Okay. Grulon Mission Northwestern, and I'm going to try to pay attention to time, and at some point I'll stop and do a wrap-up. We won't get to all the papers. That's okay. Their prediction is you relax short sale rules. That leads to higher short interest. That's their causal channel. I showed you it isn't there, but no, never mind. That leads to lower share prices. I showed you that result isn't there, but never mind. Pilot firms reduce investment and growth. They study CapEx divided by scale by assets. They study CapEx and R&D scale by assets. They study percent asset growth. They study equity issuance. They study debt issuance. So in part, they're doing some of what I recommend, which is study a bunch of related measures. But we're going to do a little more. First, we're going to study a broader measure of investment. Then we're going to study R&D by itself, because if they're going to look at CapEx by itself, we're going to look at R&D by itself. Why not? We don't know what the right denominator is to scale R&D. Both R&D over sales and R&D over assets are used in the literature. So we'll do both. We don't know which is right. We'll also look at log assets as an alternative to percent asset growth. Should come out with similar results. They find for small firms below median in assets a significant drop in CapEx over assets, significant drop in asset growth, and marginally significant results for CapEx and R&D, and marginally significant for equity issuance. Okay, those are their results. Here are our results organized in a different way. Our specification, best match specification, and what they report. Okay, so CapEx over assets, we come close in terms of significance. With best match, we're barely over a t-statistic of 2. I'll show you that that's spurious, but we get there. But we're not close to their coefficient. I don't know why. Our sample is pretty close, but our coefficient is not close. R&D over sales, they didn't study, we get nothing. CapEx plus R&D over assets, we get a coefficient that's 2/3 of theirs, and it's not close to significant, right? Theirs was marginal. Total investment, sign is the other way. They didn't study that. Percent asset growth, we get a small coefficient, theirs is 10 times as big. We decide to try log assets, we get a negative coefficient, they didn't study it. Equity issuance, we get a different sign. They get negative and marginally significant, we get positive. So nothing there. One barely significant result for CapEx over assets. Everything else has gone away. Now let's look at their result for CapEx over assets. Okay, so our sample, our specification is up here. And, you know, maybe there's something dropping a little bit, but it's not significant. Okay, here it's a little bit stronger, right? But what do I think is concerning about that? Well, I have the same gap here. This is pre-treatment. Nothing is going on. These firms were randomly assigned to pilot versus control. If this gap can arise at random, this gap can arise at random. And does the effect close after the experiment ends? No, it just stays where it was. So yes, we can find a t-statistic of 2.06 or whatever it was, but am I convinced that there's a real effect as opposed to, you know, t-statistics of 2 happen in the world? No, and I'm even less convinced when I look at the time series. LLS, I forget, it's 3 one-syllable Chinese names. That's all I can tell you. The last one is Sun. I should know this, but they predict that more short selling predicts more informative share prices, and that boards and managers know this and therefore react. And they react by making CEO compensation less sensitive to share price, because the share price is doing work directly, so CEO compensation doesn't have to do the work. I don't know about the theory, but that's their theory, right? And then investment, since share price is more informative, investment should be more sensitive to share price, and their proxy for share price is Tobin's Q. Our view is the causal chain is broken. There's no increase in short interest. There's no evidence of an effect on price informativeness, which is their chosen causal channel. What do we see? So For wealth performance sensitivity, do you see anything? I see a gap over here that kind of closes by 2004, and then no real change. That's what I see. Best match, again, I see a gap in the pre-period. It closes in 2004, no change, right? Now, what happens if you take 2004 out of your sample? Which is what they did. And they shouldn't have, because their measure was price informativeness, and price informativeness can't be affected until the experiment starts in 2005. Ordinary difference in difference will say, pilot higher here, not higher here, there's a difference. But all of it happened in 2004 before the experiment. So there's no real effect, there's just a spurious effect that you didn't catch because you didn't run the year-by-year results. Okay, so let me go more quickly over some of the other papers. We'll see how many I get to and when we stop. Okay, so this is Chen-Fu Wang. They're looking at overinvestment, and they claim that firms that were pilot did less overinvestment and less underinvestment. I'll just show you the overinvestment results, okay? Here are our results with firm clusters, okay? And we actually do find, not strong, but we find some significance. They use firm and year clusters. This is their reported result. It's just way stronger than anything else. We don't know why. I'm just going to report that, right? But this is one case where we find a result, and it's kind of consistent across specification. So is there something there? Well, maybe. What would I do about that? I'd say, well, okay, they have a measure of investment. Why don't I take some other measures, like CapEx over assets, or R&D over assets, or CapEx plus R&D over assets. Take these narrower measures that were used by GMW and see what they get for those measures, to see whether I've got a result that's really robust. And what I get in the last three columns is a whole lot of nothing. So yeah, we got a t-statistic. Maybe it was as big as 2.5. Here, interestingly, two-way clustering, here, two-way clustering is bigger standard errors. Here, it's smaller standard errors. Just unpredictable, the effect of two-way clustering. But all our t-statistics, at best, are in the 2s. Theirs is over 4. I don't know why. I just don't know why. I can't figure it out. This is a case where we just couldn't figure out what they did with their project. If we did what we thought they did, we get a way bigger sample. If we do something that'll get the sample down to their size, we get a way bigger coefficient. We kind of don't know exactly what's going on. A second over and underinvestment paper. The first one was limited to the smaller, the last 2,000 firms, the Russell 2000. This is all firms. Much simpler project, right? Again, nothing for any of the other results, really. Barely significant here, but with best match, nothing. Coefficients, we get a negative coefficient on investment pretty consistently, right, as we did for the Russell 2000. But, right, our best match is coefficient of minus 5.3 with two-way clustering. With one-way clustering, is t-stat of 1.3, not especially close to significant. What do they get? They get a smaller coefficient and a bigger t-stat. This is a recurring theme that we didn't expect, which is the standard errors, and therefore the t-statistics, end up being quite sensitive to exactly what you do. They're not very standard, it turns out. They're sensitive to specification in a way that I think hasn't been explored in the literature. Here are the annual means with TWX. So, bouncing around the pre-period, okay. All of their effect comes from 2007. By 2007, people know the experiment is going away. They know the bears aren't charging. They know all firms are being treated the same. This is just the wrong time for a treatment effect to emerge. And again, these kinds of graphs I think should be standard. These are simple univariate graphs. You can also do event study graphs, leads and lags graphs. The effect emerges at the wrong time. Do we see some evidence of it? Yeah, but it's at the wrong time. Kim Lu Peng look for evidence of less tax avoidance by pilot firms. Not sure why it would be less rather than more, sort of my same question as about accruals, but they predict it should be less. And so I've got three measures here. I've got book tax difference, which is the extent to which you pay, compute your tax based on theoretical rules and marginal income tax rates, compute what you actually pay. This is an alternate measure that captures a little bit more sample. With our specification, we get nothing. If we switch to their specification, the coefficient jumps by a lot, by about a factor of 6. It's marginally significant with one-way clusters. The two-way clusters are smaller. Their result is the same coefficient, but a still smaller t-stat. They lose a bunch of firms. We don't know why they lose a bunch of firms. Oh, sorry. Yeah. We don't know why they lose a bunch of firms, right? This is CompuStat. Firms report how much tax they paid. This is easy. I don't know why they lost a bunch of firms, but they lost a bunch of firms, and somehow that made their standard error get smaller. Didn't change their coefficient much, but the standard error got smaller. Their other measure is, I don't even remember exactly what it was, but we don't come close to matching this one, right, on either coefficient or standard error. Annual means, this is the best match sample. Well, we don't see much. You know, a little bit in 2006, but that just looks like noise to me when I see a similar gap open and then close earlier in the pre-treatment period. Again, part of why I like to see these graphs. CZC, again, I forget the names of the authors. I apologize. What they do is ask whether being a pilot firm changes your payout policy. And they report that pilot firms pay higher dividends, but not more repurchases. I can't think of a theory for that. I'm sorry, I can't. These are very close substitutes. There's no effect on total payment. They report an effect on dividends, but not on repurchases. They also study unscaled dividends. They just add up dividends over the whole sample. That's going to give much heavier weight to the big firms and total weight to the dividend payers. The ones that don't pay dividends just don't count at all, right? We think that's kind of weird. And so we also wanted to look at dividends scaled over assets. And there we find nothing at all. But even for their measure, 0.2, 0.5, 0.4, 2.6. I don't know, right? Our sample is not that far from theirs. We don't know why they get a bigger result. And once again, the result comes only in 2007 with the best match sample. That's the wrong time. This is one of my t-statistics graphs, right? Everything is not close to significant, and then that's their reported result. Let me stop. There are a couple more papers I could go through, but let me finish up and then open up for questions. So to me, the broad takeaways are something like the following. There are many opportunities for specification search, even for natural or randomized experiments. One thing you need to do is think about your causal channel and really look at it. Don't just, oh, there's kind of evidence for a causal channel, right? Are the results plausible? Without a causal channel, that's going to be hard. You need some theory. Do the results and the magnitude of the results match your theory? And we didn't go too much into that, but at least in some cases, I can't figure out why you predict this instead of that, right? Or the magnitudes don't make any sense that you come up with. Two-way clustering we talked about. It's erratic. It can dramatically understate standard errors with a short second dimension. And my view is if you're in doubt, you can use randomization inference. It's harder, but you can do it. It's not that hard, and you'll get standard deviation that you believe. I think there's real value in a pre-specified research plan. I don't do it all the time because it's a bunch of work, but if you can, it just adds a lot to credibility. I think there's huge value in being really careful with your data and sample and not giving away firms and giving away sample size without good reason. Even if it's not obvious why giving it away should cause bias. We're seeing big differences based on exactly what the sample is. And we were just a lot more careful in our specification in preserving all of the sample we could. I think there's a lot of value in posting data and code. And at the time we looked at, the finance journals didn't require this. Now many of them do. And so you could do better today. To my mind, that should include the steps to create the sample. Don't start with your sample and then go from there. LLS were at AER. They were required to post their data. We don't know how they got to their data. All right? We need to see the steps, starting from the raw data, what's your code, step by step, to get to your final sample. And I'd like to see in papers a clear explanation of how the sample was constructed. And then my own bugaboo is, why do we think t equals 2 is a good measure of statistical significance? My view for a long time has been that it's just too easy to have a result with a t of 2 or 2.5 and make it go away by changing your specification. If you're over 3, I've got more confidence. Now, not fully. I showed you some results with t statistics of 4 that didn't survive. And I could have showed you some more in one of the papers we skipped. But bigger t statistic gives you more confidence. Sample size matters. I said this. Survivorship bias matters. Why build in survivorship bias if you don't need to? Why require a balanced panel? Why require membership in the R3000 and 2005? And then I've talked about the standard errors being sensitive to sample in non-obvious ways. I think that's an avenue for future research. It's going to have to be sort of very nitty-gritty research, but clearly important. I tried to stress the value of graphing results. I tried to stress the value of studying alternative outcomes. And then beyond that, I think we need more journal openness to null results and more journal willingness to accept replication research. So journals say they're open to replication, but they aren't. They're just not. Our experience on this paper, we sent the first paper to the Journal of Finance. It had FHK, which came out in the Journal of Finance, and 3 other papers. They wrote back and said, well, we're not interested in that, but if you just wanted to replicate FHK, we might be interested in that. So I said, okay, this is Journal of Finance. It's a fancy journal. We'll write a version that only studies FHK. We sent it to the Journal of Finance. We got revise and resubmit from 2 out of 3 referees and not from the editor. Why? Because the 3rd referee was John Karpoff, who trashed the paper. And the editor decided to go with the recommendation of an author of the paper. I think that should just not be permissible. I understand why you would want to ask the paper authors what they think. I do get that. But you can't rely on them when the result is credible to the other referees. But that's what we got. And then, of course, it's hard to get anybody else to publish because it's a Journal of Finance paper, right? So the reaction of another journal is go send your replication to the journal that published the original paper. Let me almost finish with this. This is from a current working paper in political science. The purpose of the paper is to compare ordinary two-way fixed effects to the newer methods for handling staggered difference in differences designs, where the treatment emerges over time, okay? And there are a bunch of new methods that have come out in the last 7 or 8 years to solve the problems with a simple two-way fixed effects. This paper says, how much difference does it make? What actually matters if we replicate 37 older papers? And so the red dots are their results and the blue dots are the original results. What I want you to observe is there's a hole in the middle. It runs from about -2 to +2 on a t-statistic scale. Nobody published results in the middle. Here, there are some results in the middle. Here, there are none. Is this journal publication bias? It's actually a nice demonstration of it, because they weren't even aiming at this. This wasn't what they were trying to accomplish. It's not even stressed in the paper, but I look at this and say, gee, there are no results in the middle. All right, so let me finish the following way. I prepared this slide for a recent talk in Boston at the NBR, but I thought it was appropriate in Brazil too. And so I want to not be silent. I am not religious. I wore a kippah today to celebrate Israel's existence. Yom Ha'atzmaut, Israel's Independence Day, was last month. And I just want to say, and I'm going to say not only here, that we Jews aren't going anywhere, not in Israel, not in the US, and yes, anti-Zionism is anti-Semitism. Thank you. I'm open for questions.
Thank you very much, Bernie. It's always a pleasure to hear you. You are to the point in those analyses. Sadly, we are running out of time, so we have to have some time for the closing. So there will be no questions, but we have questions for over the lunch, over the afternoon. So I will ask anyone again for give a hand to Bernie, and we moving forward to the closing session. So thanks again, Bernie. No, we have a prize, and we are closing this session here. So we have a schedule where but it was worth it. So como que estamos, Rafael? Júlio. Thank you very much, Bernie. What we have now, we are going to still having this scientific sessions in the afternoon, but just in the third and the fifth floor. They are going to have another conference here, so they start to disassemble this right away. The last event we have here would be the prize session. Then I hand the mic to Júlio again.
Thank you, Ivan. So yeah, there will be the afternoon session. So stay here for the scientific sessions. Thank you. And just a few comments before the prize awards. The winning papers were selected by an external committee that evaluated the works before the start of CELS, because the presentations are going to be held. We evaluated that before the event. The committee considered the academic quality, but also the social importance of the topics that were discussed. Okay, and we thank all the presentations, the presenters and commentators of CELS Global Brazil 2024, because all the papers were really nice to hear. So this is just an award, but all you can feel all awarded, and thank you so much for all your work. So for the third place, and who will give the prizes will be Rafael and Jessica there to take the pictures. I just announced. The third place are Lina Maria Galvez Alvarez, Stephanie Jung, and Peter Krebs for the work Group Difference Regarding Moral and Legal Beliefs, Does Professional Practice Shape Judgment and Expectation About Lies and Negotiations? It was very nice, and the discussion of this paper was very nice as well. You need to take the picture. Don't forget to take the picture. Yeah. Ivan is going to take the picture as well. Thank you so much. Thank you again. For the second place, a Brazilian, Laura Chiavon and Claudio Ferraz for the paper Crime, Punishment and Prevention, the Effect of Legal Reform on Violence Against Women. And for the first place, really deserved, it is Kozar Yousefi, Sana Rashid, and Mohammed Hussein Hamati for the work Women's Waiting Time in Labor Market, Evidence from Iran. He is also a co-author, so let's wait. And now, sorry, we will break the rules a little to thank Ivan for his awesome organization of the event. So we made a little gift for him. Ivan really helped us a lot, and he was really gentle with everyone here, with all the organizers. It was really nice to have him organizing the event. Thank you. So I'll hand you for.
Well, wasn't as expected. So we are finished now. Just here, this is the main session. The scientific sections proceed in the afternoon, and for the ones in YouTube, for you here, it was a pleasure to be here. It was nice to organize all this. Most of this is the result of the effort of this team here. We have a positive, energetic ambience inside the Centro de Estudos da Ordem Econômica. I think this makes the difference, and that event showed that. And thank you again to everyone, especially to you two, to all of you. And let's move to lunch. Thank you.